start the second session today. It's 7 a.m. I would like to start at the exact time I promised last week, because it will, if I didn't start at the exact time, then it will be unreasonable for the people who have joined at the correct time. Right. Next week also it will be 7 a.m. And final session also at the same time. Right. If we recap what we have discussed last week, we had a bit of introduction on accounting, and the subject itself says this is financial statement analysis for credit management. And if you take the question paper, you can see there is a 28 mark question, which says given the fact that you'll be provided with a financial statement of a potential credit customer, or might be an existing credit customer, and you'll be asked to provide some credit facilities. Before you provide the credit facilities, you need to evaluate the customer properly. The one part of which will be actually the main part will be the analysis of financial statement. Because if you take giving a credit facility, there are many factors to be considered, but there are main two factors you have to worry about. That is, one thing is the repayment capacity, then the second thing is the security that the customer provides for the facility. Security you can do away with this course. There are different aspects to be considered when it comes to security. What kind of security? The validity of a security and acceptability of security, those are more or less matters of legal concerns. But when it comes to establishing a repayment capacity of a customer, then it will be 100% based on the techniques that you have to use in analyzing and in predicting, and finally in concluding the status of a particular customer. At the outset of this particular module, we learn the double entry system and what are the categories of accounts that are available, and the nature, characteristic of each individual asset, such as asset, liabilities, equity, income, expenditure, etc. Then we learn about double entry system and how a transaction can be accounted according to double entry system. I said in accounting and accounting, nothing to by heart except the double entry system. You have to know how to account and why it is debited and the other account credited, and you have to have valid reasons. Actually, after last week lecture, I know for sure that you have a basic accounting knowledge, right? To which that you can feel some more knowledge today lecture as well as in coming lectures, right? Having said that, we'll go to the subject itself for your particular model. Today we will learn about the financial statement analysis, right? Thank you for joining again at 7 a.m. Normally it was scheduled at 8:30 because of this structure of lecture series for banking and normal IBSL lectures. I couldn't come at I can come at 8:30 and finish the lecture after 3 or 4 hours, but due to this structural of different subject at the same time, I asked you to join at 7 a.m. Thank you for joining the subject, and make sure that you listen to the lecture properly. Everything is given in the notes. If you feel anything to be right, you can write, but make sure that you carefully listen to the subject. Right. If you take the financial statement analysis, the topic itself says it is a kind of an analysis, right? Why you do an analysis? You want to come to a conclusion. In order to make some opinion, you have to analyze something, right? Here, your analysis will be based on the financial statement, and we will be using different kind of analysis techniques or tools to analyze the financial statements. Now, the word financial statement, it's more or less sounds in your mind now, because last week also we discussed about the financial statement definition. Now, it itself says, according to LKS 1, Lanka Accounting Standard 1, there are 6 components which comprise of a set of financial statement. The main statement is the income statement, which comprise of mainly 2 parts, that is uh, the normal income statement plus the other comprehensive income statement. Both together we say comprehensive income statement. Then the statement of financial position, which was previously referred to as a balance sheet, and that gives the position which normally will be included with the asset, liabilities, and equity balances. Then we'll have the cash flow statement. If you take that particular statement, we will detail explain what it is. Normally, cash flow statement will provide the cash position of an entity compared to the profit. Now, the concept of profit and the cash is totally different. Uh, Cash is what you have to do business in day to day. It's a physical money. And if you take the profit, the two concepts are different. The profit is derived from the basis of accrued concept, but whereas cash is normally we recognize based on the cash concept. Then the fourth statement will be, we will in detail discuss the cash flow statements also, maybe today or next week. Then the fourth statement will be the statement of changes in equity. The word equity should be familiar to you. The word equity means if you take a different kind of business. In a proprietorship, it will be the capital. In a partnership, it will be capital plus current account balances. And when it comes to a company, equity means stated capital plus the undistributed reserves. Right? In the changes in equity statement, we provide a kind of a description about the entity's equity from the beginning to the year end. At the beginning of a year, what was the equity, what was the composition also, stated capitals and different kind of reserves. Then during the year, what was happened to the equity, and then at the end of the year, what is the balances in respect of each individual items, that is stated capital and reserves. We will also discuss some details on the statement of changes in equity. Then the final 2 items will be the accounting policies and the accounting notes. Accounting policies are the principles, concepts, and the assumptions based on which we prepared our financial statements. For example, say like if you take the property, plant and equipment, your non-current assets, what are the rates at which those property, plants and equipments were depreciated? What was the technique? Then it has to be explained, described in your financial statement. Some companies say it will be the depreciation technique will be the straight line method. Some companies it will be reducing balance method. Then if you take furniture, fittings, machinery, the depreciation could be 20%. But when it comes to building, it will be 2%. It has to be described, it has to be stated in the set of financial statements, because when a user uses your financial statement, the user should have known that fact, the depreciation rates. And to get a better understanding, the assumptions, concept, principles, everything has to be disclosed in the set of financial statement. That disclosure part will be represented by the accounting policies. Now, if you take a bank, there are about 20-30 pages we normally allocate to describe the accounting policies. If you go to a annual report of a bank, normally it will be 30 pages. The bank will have to describe, because the complexity with which a bank say prepare their financial statements will have to be described via these accounting policies. And the accounting notes, the final one, accounting notes means the additional notes that we provide to the items described in the phase in the main two financial statement, that is income statement and statement of financial position. If a reader wants further details, we will provide additional notes in the set of notes available in the financial statements. I recall the 6 items again, mainly the income statement, which normally comprise of 2 statements. The first one is income statement. Then the second one is the other comprehensive income statement. We will detail discuss those things. Then the statement of financial position, that is balance sheet. Then the third one will be the cash flow statement. Then statement of changes in equity, and accounting policies and accounting notes. Right. Now we are going to analyze those statements which will be provided by a customer, potential, maybe existing customer, to get a credit facility from your bank. As a credit manager, as a relationship manager, as a branch manager, what you are going to do and what you should do with this financial statement to have a better analysis and provide a good report for your higher authority to take a better decisions on the set of financial statement of this potential credit customer. Right. To take lending normally create an exposure which is associated with risk of certain future income of loss of capital or profit. Now, if you take a bank, when I last week also asked this question, what is the main asset of a bank financial statement, or the statement of financial position, or the balance sheet? What is the main asset? It will be loans and advances, right? Out of the total assets, nearly 70 to 80% of the total assets will be represented by these loans and advances. Now, normally, if you take a bank, it is materially different from a normal other business organization in the country. Because if you take a bank, the bank's total assets, out of the total assets, more than 90%, 80 to 90% will be financed by the deposit holders' money. The actual owners will only provide nearly 10 to 15% of the assets as equity. But in other companies, like a normal trading business, normal other business organization, estates, hotel, telecommunication, everywhere, the bulk of the assets will be financed, or the capital for the financing of the assets will be provided by the actual owners. Normally, it will be more than 50%, right? But in case of a bank, it is totally different. The bulk of the assets will be financed via the deposit holders' money, right? Deposit holders' money. That's why you have a separate organization called CBS, Central Bank of Sri Lanka, to monitor a bank, because banks are dealing with public money. And if you take the reporting requirement for a bank, the reporting requirement, the format of the financial statements and the presentation will also be totally different, right? That's why we have a separate division called Bank Supervision Department in the central bank, and they will normally on a given year come to the bank for an audit. And apart from that, we have SEC ruling, Company Act ruling, we have a separate act called Banking Act, right? There are a lot of rules to be complied with. And compared to other companies, bank also have a 5 compulsory uh, board committees, starting from board audit committee, board integrated risk management committee, board related party committee, board nomination, right? Likewise, there are normally a bank may have more than 5 board committees apart from the main board, but there are 5 main compulsory regulatory committees should be there for a bank. Not in the case of a normal business organization like telecom, manufacturing, trading, state, hotel, construction, right? Uh, Bank do have different set of rules, principles, and directives issued by most of the regulators, and will have to be followed in that structure. Therefore, that because the main reason is banks are dealing with public money, not the actual owner's money, right? Not the actual owner's money. Uh, for example, normal size bank normally more than 1 trillion assets, right? That means 1,000 billion assets. Out of that 1,000 billion, 1 trillion assets, normally the shareholders provide only 100 billion. 100 billion, that is 10% of the total assets. The balance 900 billion, will be the funds of normal deposit holders, right? When you are dealing with public money, there has to be set of rules to be followed. Otherwise, the funds will be vanish, and the control should be there. Therefore, central bank have to make sure that there are rules that are being followed by banks and financial institutes. There you can see in the country also on regular basis, on time to time, the collapses of the finance companies. Uh, if you take for example, I do not want to name companies, but in case of a bank, if something wrong, banks normally do have only 20% of the deposit money as liquid funds. But if something wrong, all the deposit holder come to take the deposit, then it will be a very big trouble for a bank, because they cannot give away the cash to the deposit holders suddenly, right? Therefore, the financial strength, control, risk, internal control aspects has to be there, and public trust on the particular organization should also be there. That's why you have controls like the banks will have to publish their financial statements wherever they do transaction with customers, right? If you take the first point, again, lending creates exposure, which is associated with risk, present and the future. When you lend some money to the customer, it will definitely generate risk, right? Normally, in theory, when you lend something to the government, we call that is risk-free investment. But even today's case, according to the accounting standard, we have to we have to accept the fact that even for government lending, we'll have some risk. Therefore, if you talk about the other parties, apart from the government, definitely there will be risk. Whether you have a AAA rating, whether you have AA rating, a leading customer, uh, everything is might be there, but you have a risk, not only present, future as well, right? Therefore, which will ultimately result a loss of income, loss of capital as well. Then assessment of risk management uh, is a very key skills when successful lending and banking operation is concerned. We are lacking of people who can successfully uh, assess and manage these particular risks. That's why you are coming here to follow these courses, not only to get a promotion one day by having this course, but you have to use the practical aspect also after you gain this knowledge by following this credit management course. Right. Today lecture more or less theoretical one, but when it comes to some example, I will take some examples also. Lenders involved with review and sanctioning process of credit that have a primary objective of assessing risk involved with the view to minimize losses. Again, emphasizing the point that I previously made, lending should cover assessing the risk involved with a particular customer in order to minimize losses, right? In order to minimize losses, we have to correctly assess. If you correctly assess the risk, then you can have a risk premium for that risk assessment. Normally, in theory, higher the risk, higher the return. Higher the risk, higher the returns. Very positive correlation. I will take an example in the cricketing field. Normally, you know Sanat Jayasuriya. Sanat Jayasuriya, normally he will take a high risk. Similarly, if he stays there for 50 balls, he will score at least 70 runs. Therefore, higher the risk, and he also possesses a higher percentage of chance to get out himself, right? Therefore, higher the risk, higher the return. But apart from the Sanat Jayasuriya, then if you take the Kumar Sangakkara, he won't take that much of risk, but he will be there steady as it is. And but the return, if you take 50 balls, he might score 40 runs or 30 runs, right? Therefore, in theory also, in practice also, when you have higher risk, you have to have higher return. And especially in case of a bank, you cannot take high risk. You have to take a calculated risk. Calculated risk. And what you calculate as risk has to be represented in the interest rate that you are offering to a customer. Normal customer, and for that risk, you have to add risk premium also. Hence, credit analysis using accounting techniques to assess creditworthiness of a client is important, as it will lead to a final decision, the lending process. Right. When you before granting a loan to a customer, you may go and interview. You may visit there. You might show the production. You might go and visit the factory. Everything might be there. But at the end of the day, which is important is the financial results, right? Financial results will be the only source of information for you to grant the facility, right? Otherwise, the other things are qualitative factors. Qualitative factors for you to decide on lending, but the quantitative, more or less the quantitative one, more than 90% will be given by the financial statements. Therefore, the proper analysis of financial statements is a must. if you do not properly analyze your financial statement, the persons who are taking decision will be in trouble. Right. Then I went through the components of a financial statement, each one. First one is the income statement. I mentioned, including the statement of other comprehensive income, including the statement of other comprehensive income. Then statement of financial position, that is balance sheet. That is balance sheet. Then the third one, cash flow statement. Cash flow statement. Fourth one, statement of changes in equity. Right. Then accounting policies and accounting notes. These are the 6 components. Now, when you are asking financial statements of a customer, that should comprise of these 6 statements. Normally, some customers, they don't know about these statement. They just give the income statement and the balance sheet. But you have to ask about these statements as well. Now, these statements will serve different purposes. If you take the cash flow statements, it's a must. It's a must. When it comes to a credit, evaluating the credit facilities, a cash flow statement is a must, right? You have to know the cash position of individual clients and the activities through which they derive the cash flow for the business. Now, if you go to the cash flow statement, there are mainly 3 activities. Uh, Cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. And whether the particular customer having some cash flow difficulties can be easily uh, identified by analyzing the cash flow statements and the processes through which he generate normally cash inflows, the processes uh, uh, where he conceived more cash outflows, you can easily identify. Therefore, individual each statement in the list given serving different purposes, which will ultimately add value for you to take a very good credit decision. Right. Then in Sri Lanka, you can find different business clients like individuals, sole proprietorships, then partnership. Mainly the partnership will cover the partnership ordinance 1890. Then companies registered under Companies Act. There are different kind of companies. I do not want to go into detail. Private companies, public limited companies. Then you have clients like associates, clubs, and other clients. Normally, this particular module will not focus on the theoretical and the legal aspect. It will be covered by a different persons. But the analyzing part of the financial statement is our main focus. Therefore, there will be different kind of people, or the business organization will come to get lending facilities as listed here. Then one by one, we will detailedly analyze. To take the individual, the how do you assess risk of an individual or credit worthiness of an individual? Normally, you can ask credit facilities to individual will normally be considered based on their income, right? How do you assess the income, wealth, or standing in the society, right? In order to assess the individual's income, wealth, or the standing, you will have to ask tax payment conduct of bank accounts will be as the evidence. Normally, they will have to provide a source of income, or if he is engaged in any employment, you can ask the salary certificate, whatever the sources to confirm the monthly income. And the banking accounting details, whether your bank or other bank, at least for last 6 months, what was the income. But in case of self-employed people like tailors, haircutters, whatever it is, there are self-employed people. It is very difficult for you to assess the income of that particular person because they don't have a proper. They have not, even though they have income, they have not deposited the money in a bank account. Then they will be in a struggling situation for you to give their income sources. Then what you can do is if the facility is not that much urgent, then you can ask that particular self-employed person to deposit all whatever the income he earned into a bank account. Then thereafter you can assess his or her income sources from that bank account. Then second category is sole proprietorship, the who are doing businesses as a sole proprietor. Considering the credit facilities will be similar to individual, more or less similar to individual. Income will be based on business profit, right? You can ask set of financial statement. Normally it will not be a proper set of financial statements as far as the sole proprietorships are concerned. They are very reluctant to have records on the financial statements. They do business, but at the end of the year, when it's come to income tax payment, they only worried about at that juncture to prepare the financial statement. Then suddenly they will take the bank statement, everything, and go to a auditor or might be a accountant to prepare the set of financial, which is not the correct way. But encourage every time you lend to a customer, especially to a business organization, you have to have credit plus something. Encourage your client to have a proper set of financial statement, without which definitely that customer will be fail. Now I mentioned last week, when your mother or father keep records on the financial income of that particular household, then she can have a list of information, list of expenses of the every month and comparison. You can have a variety of information and finally come to a very good decisions based on the information. Likewise, in sole proprietorship also, even though the business is very attractive, you can find there are customers, very good sales are there. If you do not maintain the records properly, accounting records properly, in future, the whatever the decision that you are taking, you don't know about your income, you don't know about your expenses, asset, liabilities, and equity, and the products won't be properly priced. As a result, after 6 or 8 months, there will be losses incurred without knowing to the particular owner of that business. Therefore, encourage your even the business is so small, small or medium. Encourage all of your business organization to have keep proper books of accounts. That is a must. You can hire by giving a partly qualified person a salary amount of 30 to 40,000. You can hire an accountant, right? Which is very beneficial to the business organization, without which the business organization cannot survive. Therefore, I am emphasizing the fact that you need to have proper books of accounts in a business organization. Today, it might be a good business, but in future, you can have to face various difficult situations. But if you have the information, with the information you can correctly or you can properly face the difficult situations, right? Then partnership business. Normally partnership business is governed currently in Sri Lanka, the 1890 partnership ordinance. there should be a partnership agreement, right? Before you disburse any facility to partnership, there should be a partnership agreement which should state the sharing of profit, interest on capital, uh, various restrictions. Everything should be there in partnership agreements, because individual or the proprietorship or the partnership, in that case the legal entity is not there. Therefore you have to be worried about, if something goes wrong, you have to go behind the partners as well. Therefore a proper agreement should be there to govern the individual respective uh, whatever the responsibilities and legal formalities of the partnership. Then for a partnership, before granting credit facility, you should ask business registration, tax payments, conduct of bank account will have to be reviewed with the evidence proofs of business. Apart from that, make sure that you have proper set of accounts. That is the only source of information for you to analyze the credit worthiness of a partnership as well. I mentioned again earlier also, in the event of a legal action against partnership business, action should be filed jointly and several liability on the partners, not as a business. Then the last category is companies business registered under Companies Act. We normally call companies. It is the Act number 7 of 2007, which governed the companies in Sri Lanka. This was effective or came into enacted in 2007. Exact date is 3rd May. Now compared to individual proprietor and a partnership, take a business like a company, legal entity is there, liability of members limited to the extent of capital that they have contributed, and the fact that you can add any number of shareholders to the business is also very positive as far as a company is concerned. But from the point of view of legal aspect and the things that you have to comply with, it will be more or less comparatively higher than individual business organization or a partnership when as far as a company is concerned. Then few points as we go on. Normally we do prepare or analyze the financial statements of a company, not not a sole proprietor or partnership, but it will be a company. When it's come to your exam also, it will be a company's financial statement for you to analyze the financial statements. A few points, important points, but I won't go far on the technical or the legal aspect of a company. But when it's come to accounting, these are the important areas for you to worry about when you are going through financial statements of a company. Important features of Company Act number 7 of 2007. These are some modification made to the previous act. Very important point. In the previous act, there was a concept called par value or the nominal value that was out, and now the new concept is the stated capital. Now in the previous act, you can have a par value of 10 rupee, 100 rupee or 1 rupee, and the price that you issue a share over and above the par value was known to as a share premium. And if you issue a share below the par value, is known to have the share discount. Now those concepts are still no more valid. Those concepts now abolished, and now you have only the issue price. The stated capital means the issue price into number of shares that you have issued. In previous act, there were two main like documents for you to have before you start a company. That is articles of association and the memorandum of association. And memorandum explain the objectives and the scope of your business, whereas articles explains the powers, rules, and everything of your business. But according to the New Company Act, no memorandum is needed. Memorandum need not to be provided for the registration because any company do any business after registration, no need to restrict their objective or business to a particular subject or area. And no limitation in issued capital. There was some limitation when you register a company. You have to register with a capital called authorized capital, and whatever the amount that you registered with the company act, you cannot issue beyond that amount. Now that concept also no longer there. You can issue any amount of capital to shareholders. And I earlier also mentioned no limitation of business activities of a company. Previously, if you registered for banking, you can only do banking. Now there is no such a restriction. If you want to do any other business apart from the banking, there is no limitation. That's why the memorandum of association is no longer required. Then the articles of association provide the details of the company and also the rules and regulation governing the activities of the company. It is a must document. It should provide the rules, everything, guidance, everything should be there. Articles provide the powers to the directors, the other parties, wherever necessary. Rules and regulation should be there in the articles association. And you can find in the company act there's a schedule called first schedule that provide a model of articles of association. If you are interested in forming a new company, you can get that format and have the articles prepared. I won't spend a lot of time on these concepts. You can read and understand. Companies can be formed under New Company Act, limited liability company, unlimited liability company, and limited by guarantee. Apart from that, Secretary to the Finance Treasury on behalf of the government has powers to incorporate single shareholder company as well. There is a different power given to the Treasury of the country. And this is very important. If you go to section 49 of the Companies Act, you can easily download this Company Act. I think it is very important that you have a copy of, you can get a PDF download of the Company Act. And once you download, you can, if you are interested in any section, you can easily find that whatever the legal formalities in the Companies Act. If you go to section 49, it says a company can have different classes of shares which have different rights, right? Mainly there are two classes of shares, that is ordinary shares and the preference shares. Normally ordinary shares have the voting power and no fixed dividend established for that share. But in case of preference shares, no voting power, but they have a fixed dividend payment. We consider the actual or the right shareholders of a company as the ordinary shareholders because they are taking the risk. No share will have a nominal or par value. We have already discussed that thing. Shares in a company shall be transferred in the manner provided in the article section 49. I won't go to that extent. If there is no restriction of the transfer of shares, it is termed as a public company. Such company should use the public limited company PLC, right? PLC word along with their name. You can read and understand these points. Then if a company prohibits offering shares to public, sections 27A, then it is termed as a private company. Now, even though this is technically explained, a very basic thing is private limited company, they cannot ask public to contribute to their respective share capital openly. But in case of a public limited company, they can openly invite all the members in the country to contribute to the share capital of their company. But in case of a private limited company, you cannot openly invite any person, but you can have other relationships and other invitations via other modes to fill your capital. Shares may be issued for cash or consideration as decided by the board. Normally, shares will be issued by way of cash. Where shares are issued for consideration other than the cash, the board of directors shall determine the cash value of such consideration for the above purposes and take that into accounting calculation of the stated capital. Then this is also a very important point. These are the points through which you can ask your client to prepare the financial statements and provide whatever the necessary information to you, especially in case of a public limited company, even the private limited company. Now there is a section called 148. In that section, it clearly says the board of directors ensure that the company, right? The board of directors, in case of a company and a proprietorship partnership, right? There is a main difference, right? What is the main difference? In a proprietorship or a partnership, the actual owners will come to manage the business. Actual owners will be there to manage the business because there are few number of owners, maybe 1, 2, or less than 10. In case of a private limited private limited also, the case may be the same, right? But if you take a public limited company like bank, there are number of shareholders. If you take the number, exact number in a bank, normally there are 20,000 shareholders. 20,000 shareholders. If all that 20,000 shareholders, meaning the actual owners, come to manage your business, right? In your bank that you are working for, if all shareholders come and manage the individual branches and head office departments, what will happen? There'll be chaos, right? Therefore, in a company, the main difference is the ownership and the management will be done by two parties. Owners will be different, but the management also different. The owners won't come to manage the business. On behalf of all the owners, there will be a particular 10 to 12 shareholders, namely board of directors, will do have some part of management of the company. Normally in a big company, headed by a managing director, there will be a set of corporate management members and a set of senior management people to manage the business. And we have a board of directors appointed in an AGM on an annual basis by the shareholders, normally which comprise of 10 to 12 directors. They also will have some aspect of management, like through their board meetings and other subcommittee meetings. But normally it will happen on a monthly basis. On a month, only one board meeting is there. Therefore, the main management part in a company will be done by the managing director and the corporate management and the senior management, right? But in case of a proprietorship and a partnership, the owners and the management will be the same. Therefore, we say in a company, there is a concept called agency concept. On behalf of all the shareholders, the management team will do the management. They are the agent, right? The actual owner will be different. Therefore, in a company, normally the interest of owners and the interest of management team will get differed. To manage that, you can have different strategies. The owners actually wants more profits, more dividends. But in case of the management team, they want their salaries, they want their business to do a smooth, they want to retain some money for the future business expansion, right? Those are their intention. But as far as owners concerned, actual shareholders concerned, they want to have more dividends. Therefore, this problem is there in a company, a big company. Therefore, you have to manage as board of directors will have to be manage this problem as well. In section 140, that is a kind of a background for this point. In under section 148, the board of directors should ensure the company correctly record and explain transactions, right? There should be a process through which all the transactions are correctly recorded and it should be correctly explained in the financial statements. That responsibility is given to the board of directors. By this section 148, the board of directors should ensure that correctly recording and explanation of every transaction happening in a business organization. Then the financial statement should be prepared by a responsible person called Chief Financial Officer or the CFO, who should certify that the financial statement for compliance with the Act. Act means the Companies Act, signed and dated by two directors on behalf of the board. Not only the CFO have to sign, on behalf of the entire board, two directors will have to sign. The financial position determined at any time with responsible accuracy, financial statements readily and properly audited by stipulated auditors. Now, under section 48, the board should ensure that the financial statements are properly prepared and there is a responsible officer called CFO and it should be signed by the CFO plus the two directors on behalf of the entire board. Not only that, it should be properly audited by, normally in a company, there is a requirement to get it audited by a chartered accountant, right? By a chartered accountant. Then under section 151, every company shall prepare financial statements within 6 months of the end of the financial year or within the extended time determined by the registrar of company. I won't come to the second part. That is a special case where you can ask a special extension from the registrar of companies if you have a difficulty. But apart from that, within 6 months, a company's financial statement should be prepared and sent to the company register. That meaning, if you go to the last year end, that is 31st December 2019, before end of 30th June 2020, you have to prepare and audited the financial statement and send a copy to the register of companies. Fail in which, here, point number three, no, I'll go to the point number 2. An annual return must be filed with the register of companies along with the audited financial statements. Number 3, fail in which non-compliance, every director in default shall be guilty and liable for 100,000 fine. 100,000 fine. Right? Now, these are regulatory guidance and the laws. Therefore, you have to definitely follow these things. Otherwise, every director will be charged with 100,000 fine. Can be charged, right? If you want extended period, you have to get a special permission from the registrar of companies, asking extension period, providing the details for the difficulty. Right. In case of group financial statements, that is under section 152, the similar provisions are there. A group means if you have if you have invested more than 50% of the shares in another company, the the company who has invested in the shares are called a parent company, and the company whose shares are being taken by the parent company is known to a subsidiary. Therefore, if you have a subsidiary, one or two subsidiary, you have to prepare group financial statements. Group financial statements also have the similar provision under section 152. Right. Under section 166, the board of every public company shall within 6 months after the balance sheet date prepare an annual report on the affairs of the company during the accounting period. Right. This is only for the public limited company, not for other companies. They will have to prepare annual report, right, which should comprise the lengthy details on the following, and the annual report should be giveaway to all the shareholders before the AGM, before the 15th working days prior to the date of the AGM, right, for them to study and come to the AGM and ask questions from the directors. 15 working days, right? We will go through the facts that you need to given in the annual report under section 168. Normally, the content of the annual report should comprise of these things. It should have some introduction about company's nature of business and type of business, right? Company's nature of business and the type of business. Some introduction should be there. Then number 2, sign financial statements of the company for the accounting period and the group financial statement. The financial statement should also be included in the annual report. It's a must. Then auditors report on the financial statements. The auditor should give his opinion on the financial statements, and any changes in accounting policies. I mentioned what is an accounting policy. Then particulars of entries in the interest register. That is, if you have issued debentures, if you have borrowings, those are the things that you normally enter in the interest register. If there are entries, you have to mention that thing also. Then the important point, right? Remuneration and other benefits of directors. Now, I mentioned earlier, board of directors will represent the entire shareholders. Therefore, when it comes to directors, it is very important that they show their independence and their transparency. Therefore, they will have to show every single cent the company paid to them, right? Every single cent that the company paid to them. That's why remuneration and other benefits of directors, there should be a separate item in the financial statement indicating the directors' fees and other benefits. Directors' fees and other benefits. In the AGM, every shareholder has the right to question these details. Directors' payments, right? It should be a separate item, right? The shareholders should know if the directors are paid with fees, what is the amount? Per sitting in a board meeting, what was the amount, right? Then the second point, depreciation provided in the financial statement. That is also a very important point. What is the amount that you charge to the P&L as depreciation should be separately provided in the financial statements. Depreciation is a normally non-cash item. You are not giving or paying any cash to third party as depreciation. Therefore, that is also need to be separately indicated. That is a Company Act requirement. Then the next point is the total amount of donation made by the company, right? This is also very important. You might wonder why donation here, right? To take donation now, all the things will be finally determined by the board of directors, right? In a company. And for example, say in a company, the chairman of that particular company, he want to give some donation to his school. He's a very good old boy in that school. He want to give away, say, 10 million to his school. This 10 million won't be giving through his pocket. It will be the company money. It will be the company money. He uh, decided to give to the his school, right? What will happen? Now, similarly, if other directors act like this, the money in the company will be given to all the leading schools in Sri Lanka, right? And some other director might be having a temple in his village. He want to give a 3 million to build some say chaitya or whatever it is, right? Now, in that case, the transparency, independence is missing. That's why every single donation distributed or given away to other third parties has to be presented in separately in the financial statements. Now, in AGM, the donation list will be presented by the chairman to the shareholders. And in that donation list, every shareholder has a right to ask question why it is so, right? If some links between directors and the donated party, then shareholder has the right to question, right? Therefore, the total amount of donation made by the company has to be separately presented in the financial statements. Then the next item is audit fees and non-audit fees, right? Even though it is not material, amount is not that much high, audit fee and non-audit fee has to be separately given in the financial statement, right? Names of person holding position as directors, their names, their details. Normally, we provide their pictures as well, and their qualification has to be presented because the shareholders should get to know who is this person. If there are some links between this person and other companies, they will have to get to know. Then the annual report should also be signed by 2 directors on behalf of the entire board. Right. As the discussion is more theoretical, don't sleep again, right? We'll come to the calculation part once this theoretical stuff is over. It won't take that much of time in. But I have to explain these information because these are very directly related to the accounting and need to be for all of you need to know about these things, right? Next, before I start the next slides, I will take a small break of 5 to 10 minutes, right? Take a 5 minutes break, right? We'll start again. Now, next point is the distribution. Distribution also very important aspect in terms of a company. Now here, what is different in the new Company Act compared to the previous one? You have to do a special test called solvency test before you distribute anything to your shareholders. Normally, distribution happens via dividends. Normally, you declare dividends for your shareholders. Now, before declaring a dividend to the shareholders, according to the new Company Act, it should ensure that the company has a solvent position before distribution this dividend. The solvency test has to be done and by using an external auditor to do a solvency test prepared, and the company will have to give all the information, relevant information to the auditor to establish its solvency. Now, in this session also, we will get to know how do you calculate the solvency of a company. A very easy calculation is there. And if you go to the point number 1, the board of directors are required to always be mindful and conscious about the solvency of a company. That is very understanding. Then the concept of distribution in terms of act, meaning even though the theoretically something is there in the slide, but the main distribution will happen via dividend. A dividend can be of two forms, that is cash dividend and the scrip dividend or shares to shareholders. Here consists of transfer of cash or property other than the shares of a company, incurring a debt to or any other benefit on behalf of the shareholder. When considering the shares held by a person, the distribution includes dividend payment, redemption of shares, reduction of shareholders' liability, then distribution of indebtedness, that is issuing debentures. These are theoretical points you can read and understand, but I'll directly come to the solvency test thing. In terms of section 57(2), in determine whether the company satisfied the solvency test, the board shall take into account these two things. The most recent financial statement prepared in terms of section 151 and the circumstances the directors know or ought to know which affect the value of the company's assets and liabilities. Those are the points you have to remember. A fair valuation of or other methods of assessing the value of the assets and liabilities. And if you go to the assessment process, these are the 2 points we have to worry about. First point, when an external auditor, we are not doing these things, but we will give the information as a company to the external auditor. External auditor should prepare this and give the conclusion to the board of directors whether the company is solvent or not. Now, in the assessment of solvency, the external auditor will assess 2 points. Mainly 2 points are there. Very easily calculate, even for you to calculate before calculating the external auditor. You should get to know about using these 2 points whether you have a solvent position or not. Now, what is important is before you distribute any dividend, you have to get a solvency test report from the external auditor. And if it is only positive, you can distribute the dividend. Now, the 2 points are make sure that you have green light for these 2 points, not green light for 1 point and red light for other. Both points should have green lights, right? You have to pass the 2 points to distribute dividends. What are the 2 points? Very easy. First point is ability to pay debts in normal course of business, right? The company should in a position to pay its debts in the normal course of business. That is established. How that is established? Your company's current asset should be higher than the current liabilities. If a company current assets is higher than the current liability, then that company can pass the first test, right? First green light can be obtained in that test, right? Very easy to conclude. You have to take in a given date, you have to take your current assets and your current liabilities. Then if the current assets are higher than the current liabilities, then you can pass the first test. Very easy to conclude. Then the second point, the value of entities assets less liabilities, stated capital and proposed dividend. Now, in the formula, you can go to the formula. Total asset figure should be higher than the total asset figure should be higher than the total liabilities plus stated capital. Total liabilities plus stated capital. You might wonder what is missing. Your total asset figure should be higher than the other side. You have total liability plus stated capital. Now, in a balance sheet, you might think, oh, if you take all of these things, the total asset should be equal to the total liability plus stated capital. What is missing item here? The missing item is reserves. In the total liability and stated capital side, the missing item is reserves. Meaning, for it to be higher, the total assets should be higher. For total assets to be higher than the total liabilities and stated capital, the company should have reserves, right? In this formula, we haven't taken the reserves, right? For this formula to satisfy it, you should have some reserves. If you don't have any reserves, then the total assets will be equal to total liabilities plus stated capital, right? Assume that your company don't have any reserves, then this formula will be total assets equal total liability plus stated capital, right? If there are reserves only, this formula will get validated, right? You can pass only if there are reserves only. Right? For it to be total assets higher than total liability plus stated capital, right? There should be some reserves, right? The missing item is the reserves. Basically, the 2 points are your current assets should be higher than the current liabilities. That is point number 1. Then point number 2 is you should have adequate reserves, right? For you to get through the solvency test, 2 criteria: current asset should be higher than the current liabilities as at given days. Then number 2, you should have some reserves. Otherwise, you cannot pay dividends, right? When external auditor, when he or she establishes the solvency test, uh, he or she go through these 2 points: whether the company's current asset is higher than the current liability. Point number 2, whether the company has adequate reserves to pay off these dividends. You need to pass through all of these 2 points, not only 1 point, all of these 2 points to get into the solvency test. If you only pass solvency test, the directors can declare dividends. If a company cannot pass the solvency test, then it will be restricting the directors to declare any dividends for that company, right? In case of a bank, the current assets, current liabilities are no more there. They don't have in a bank balance sheet, no current asset, no current liabilities. But in a normal business, you have to find the current assets and current liabilities. You have to ask when they, before declaring the dividends, whether they do have a solvency test done by auditors, right? You should ask a copy of that solvency test, right? Now, the important point is, after you granting a loan, if the owners can distribute their uh, portion via dividends, then you will be in a trouble. Therefore, every time the company declare dividends, make sure that the company took a solvency test certificate from the external auditors for your benefit and for your benefit of the bank, right? According to New Company Act, without a solvency test certificate from the external auditors, the company cannot give away dividends. Right. I think yeah, you get a proper understanding on the solvency test. Right. Now we are going to analyze the financial statements. Uh, now, before you do a proper analysis, you should have a good writing skills also, right? You should have a good writing skill also. Uh, Whatever the unnecessary data you should drop, because if it go to the level of managing director, if it go to the level of board of director, if it go to senior DGMs, they won't possess that much of time to go through the points that you are given in the financial statement analysis in the credit paper. Therefore, briefly to the point, you have to explain what it is, and whatever the important point, you have to summarize and uh, present it in the face of the credit paper uh, to get a better decision making by your higher authorities. Right. In order to do a proper report, now at the end of the sessions and at the end of the exam, in the question itself asks to do a proper report, right? In order to do a proper report, you should know about these things, right? First point. What is the first point? Knowledge of the client's business is necessary in the process of analyzing the creditworthiness and to assess the level of risk involved. What is that point? Right. Knowledge on the client's business. Right. If you take especially the branch management people and the relationship managers, they do find different nature of business clients in their portfolio. Some may be hotels, some may be trading, some may be construction. Some businesses are in the tourism sector, some businesses are in the education sector, health, right? Different, it might be states, right? Coconut state, tea states, different nature business. But if you happen to find a new business entity, right, uh, for which you didn't have any exposure previously, any experience previously, you have to get to know about some technical jargons specialize into that particular business nature. For example, say uh, if you happen to provide a loan to tea estate organization, a plantation company, right? In plantation companies, there is a concept called nurseries, right? There is a concept called nurseries. Now, normally nursery sounds very familiar, but a nursery, normally you know that in your mind, the first thing you come to in your mind when you heard the word nursery will be a Montessori, right? Will be a Montessori. But in case of a plantation company, nurseries means newly planted tea or coconut or rubber plants, right? Sometimes the plants to be planted in the states are called like it's like a stock, right? Plant stock, right? New plant stock is called nurseries, right? Now, if a person coming from a different industry to a bank, if we say non-performing loans, if we say a different wording like say specific provision, general provision, right? Impairment. Those are new words to that particular person who has come from a different industry, right? Normally in a bank also, the people now, if you take some different specialization position, say marketing, say HR, maybe finance, people recruited from for a bank from different industries. You might have persons like that in your higher management. For those people, the banking terms are very new. Non-performing, impairment, cost to income, right? Liquidity, capital adequacy, right? There are a number of new words, very cumbersome, very complexity, technical jargons are there in banking industry. Similarly, if you happen to lend to a new industry, you have to gather knowledge on that industry, especially the terms, jargons. What is it, right? If you go to the tea industry also, different kind of jargons are there, right? If you go to the construction, working progress, right? Percentage of work completed, right? Refurbishment, different things are there. If you go to the polythene industry, master batch. What is a master batch? Master batch. Master batch is the main material that is used to generate polythene bags, right? Likewise, if you go to different industry, hotel also there, occupancy ratio is there in a hotel, right? Different terminology, different ratios, different technical knowledge you have to gather, right? It cannot be gathered in a single day. Use by experience in the or by when you're going to factory visit, when you're going to meet some people, before you go in there, you have to gather this knowledge. Therefore, knowledge of client business is very important in process of analyzing the credit worthiness and to assess the level of risk involved, right? If you don't know about the risk involved or the about the business organization, about the industry, you cannot properly assess the level of risk involved, right? Then essential components are business background and nature of business, macroeconomic factors sensitive to the business, right? Macroeconomic factors sensitive to the business. Now, especially in the pandemic season, now we are all talking about corona virus and the COVID-19. Uh, and I think the people, most of the people, they think that the economy impact has already happened in Sri Lanka. In my opinion, it has not yet be the peak is still not happened. I guess it will happen after September, 30th September, after this moratorium period. Still people are getting the moratorium in the moratorium period after 30th September. If you can recall, last year April 21st, having this Easter bomb attack, government initiated moratorium for tourism industry. Before you end the tourism industry moratorium, you had this SME moratorium, and before ending that SME moratorium, you have this COVID-19 moratorium, right? And now in the bank's loan book, more than 50% of the loans are subject to these moratorium aspects, right? Having said that, banks are the big, now people think that banks are earning a huge amount of profits, but if you uh, happen to find the financial statements of the 6 month in every bank, you can see before August 15, every bank has to publish their 6 month financial statements. In most of the cases, the particular second quarter and the half year accounts will be in a declining situation, right? Will be in a declining situation. But I guess the peak of this COVID-19 hit for Sri Lanka will be in the last quarter and the next year, right? Last quarter and the next year. will be the peak of this COVID-19 effect on the Sri Lankan industry, right? Now, if you take the second point, macro factors affect sensitive to the business. Now, every organization now, if you take last year Easter bomb attack, it was affected to only to the tourism industry and some part of some other industries, but by and large the tourism industry. But in case of this COVID-19 pandemic, it will throughout the every industry it will have effects, and we can show some signs of effects of the COVID-19 happening started. Then product service quality, marketability, and trading outlook. When you understand the client's business, these aspects should be noted also, whether that client has a very good product, service quality, product quality, and the marketability is there, and their trading outlook is what is happening there. Everything is covered here, understanding the client business. Basically, in a nutshell, before you analyze a particular client's financial statement, you should have a good understanding of the client business, whether it is micro, macro, whatever the information. When you are going to the field visit, gather everything and make use of all the information gathered about the client's financial statement. Right. Then I won't spend much time on this slide. The financial statement definition. The objective of the financial statement is to provide information about the reporting entity. 2 points are there. Financial performance means the profit or loss, and the financial position means asset, liabilities, and equity. That is useful to a wide range of users for assessing the stewardship of the entity's management and making economic decisions. Whatever the analysis will help the decision makers. Last week we identified the decision makers. It may be owners, it may be management team, it may be customers, it may be suppliers, employees, trade union, Inland Revenue Department, external auditors, whatever it is. They use these financial statements for decision making. The financial statement should provide the main 2 points, that is about the financial performance, that whether the company is in a profit or loss situation, that is financial performance. Then financial position means about the entities, asset, liabilities, and equity part. Asset, liabilities, and equity parts. Normally, we use accounting standard to prepare the financial statements. Last week also, I mentioned in Sri Lanka, the main body for accounting is the Institute of Chartered Accountants of Sri Lanka. Normally, we refer to CA Sri Lanka, and there is a council in the CA Sri Lanka, and they have appointed accounting standard committee, which comprise of chartered accountant and the people from company registrar, central bank, and the people from Chamber of Commerce and Federation of Chamber of Commerce and SIMA Sri Lanka. They will produce the accounting standard. There are 3 things, that is producing new accounting standard, amendments to the existing accounting standard, and abolishment of the existing accounting standard. What will happen once they produce the accounting standard? It will go to the Council of Chartered Accountants of Sri Lanka. Then it will be sent to the Parliament for their approval. After the approval of the Parliament, it will be gazetted, and they will become pillars of the law of the country. And this is some kind of, the slide is some kind of explanation of that and how Sri Lanka accounting standards are being generated. And the act I mentioned in Sri Lanka, there is an act called 15 of 1995, Accounting and Auditing Standard Act, that gave the powers to the CA Sri Lanka have the main governing body as far as the accounting and auditing aspects are concerned.
Presentation.
තාම share වෙලා නැහැ. Right. Normally it is very difficult when you are having these online sessions. You have these technical failures. Yesterday also, when I was conducting a business accounting subject, suddenly the internet got failed, and I was presenting more than 10 to 15 minutes, even though the internet is not there. That is what normally happen. Now in this classroom also, there are about 500 to 400 seats are available. No one is there. I am presenting here. Now you can see the presentation. Even though it was not shared previously, you have the slides with you. Right. We said there are two kinds of financial accounting standards. That is Sri Lanka accounting standards into two parts. That is Sri Lanka Financial Reporting Standard (SLFRS) and the Sri Lanka Accounting Standard (LKS). Now this particular amendment was enacted in 1st January 2012. Before that, we have only the Sri Lanka accounting standards. Component, I won't explain this. You know that there are 6 components in the set of financial statements. That is statement of financial position, statement of comprehensive income. We will in detail talk about the balance part of the lecture about these 6 components one by one, right? First, we come to the statement of financial position, right? Normally, statement of financial position previously referred to as the balance sheet, right? You know, a balance sheet should comprise of only out of that 5 categories: asset, liabilities, equity, right? Out of the 5 categories, asset, liabilities, and equity should only be comprised in the balance sheet. Income and expenses should not be included in the balance sheet, right? Income and expenses should only be included in the income statement, not in the balance sheet, right? There are some clients, even the corporate clients, sometimes they try to hide some expenses, right? Whatever the way, the only way to hide an expense, you treat that as an asset. You know, if you take an expense, a debit balance is there, right? If you take an expense, debit balance is there. If you do not treat that expense as an expense, then the only way you can treat that expense as an asset, right? Therefore, some companies, there are some smart accountants, they will treat an expense. When you take out an expense, your profit will get higher, right? And if you want to treat an expense as an asset, you have to put that expense value into the balance sheet. Therefore, make sure that your balance sheet won't include income and expenses. It should only include the real assets, real liabilities, and equity parts. You know for sure an asset, for it to be an asset, it should generate some income to the organization, directly or indirectly, short term or long term, right? For an item to be recognized as an asset, it should generate some income to the organization, directly or indirectly, for a long term period or a short term period, right? Now, when you're going through the client balance sheet, make sure that you can find the items as assets which generate income to the organization. If not otherwise, directly question your clients why this particular item recognized as an asset. Then when it comes to liabilities and equity, liabilities are commitments, whether it is short term or long term, you have to repay a commitment, right? Sometimes in order to reduce your profits, income items can be recognized as liabilities, right? For a year, you can see a particular company, they think that their income is so much high that particular year. In that case, they want to hide some profit. In that case, they can take a income item as a liability in a balance sheet. Therefore, make sure that your liability side, there is no income items, right? Then for a company, equity part should only represent the stated capital and the reserves. Stated capital and the reserves. Right. I have given a vertical format in the screen as asset side. You can see under assets, first item is the non-current assets. Under non-current assets, you can uh, show the property, plant and equipment, uh, whatever the non-current assets part, properties, building, land, machineries, furniture and fittings, everything can be presented. The important point is here, those assets are subject to depreciation. Therefore, the first you have to mention the cost amount, then deduct the accumulated depreciation, then the written down value, Then the second item is the long-term investment, like fixed deposit. Maybe you have acquired some other company shares, right? Those are long-term investments. Then investment with more than 1 year maturity, investment in company shares. I mentioned that those are the long-term assets. Then you have to show the current assets. Under current assets, main famous three items are the stocks, inventories, then debtors or trade receivable, then cash. But there are some other current assets like prepayments or amounts receivable, right? Income amount receivable, those can be treated as current assets. Make sure that every item in the balance sheet phase have generate some income to the organization, directly or indirectly, if it happen to recognize as an asset, right? You have to question your client. If there are suspicious item, make sure that you call any friend in the finance department. If you cannot recognize particular item as an asset, check with the finance department. If they have knowledge, you can check with them. Then if you go to the other side of the balance sheet, liabilities and the equity. Under liabilities, first item is the equity part, shareholders equity and reserves. Then under shareholders equity and reserves, you have stated capital, reserves, retained earnings. If you take the reserves, all undistributed profits are called reserves. There are different kind of reserves: general reserves, retained earnings, revaluation reserves. Different reserves are there. Uh, Everything will be added as the equity. Now, if you take the stated capital, make sure that you have only the issued and the recall stated capital of a company. Then the next category is the non-current liabilities. The liabilities which will take more than 1 year period to repay are called non-current assets. So non-current liabilities. A few examples are given: long-term loans, debentures, retirement benefits. Those will take more than 1 year period to repay. Then under current liabilities, accrued expenses, tax payable, creditors, right? Those are the non-current liabilities. Normally, we take within a 1 year, we repay these non-current current liabilities. Then we'll come to the comprehensive income statement. This is the basic format. Under LKS 1, the formats are given for companies to publish their financial statements. If it is not a public limited company, any company who is publishing the financial statements, they can have they can follow that formats given in the LKS 1. But for other companies, you can use these formats given in my formats. Under comprehensive income statement, if you take the comprehensive income statement is comprised of two parts. First part is known to have the income statement itself. Then the second part is other comprehensive income statement. Other comprehensive income statement. The total of the statement is known to be the comprehensive income statement. The first part is the income statement. In the slide, it is given as the income statement. Normally, we prepare two set of statement in order to give better understanding and minimize the misleading of the users of the financial statements. I will explain that fact at a later stage. If you take the income statement first, this is the income statement. All the normal income and expenses will be presented in the income statement, right? If you take this sales, cost of sales, then you have gross profit, add other income, then you have total income. From the total income, you deduct the expenses, then you can find the distribution cost, deduction, administrative cost deduction, finance cost deduction, then profit before tax. In a company, you have a tax liability, then you have to deduct the taxation, then profit after tax. Now, in case of tax, there is some argument where the government have implemented the corporate tax in their budget proposal effective from 1st January 2020. The corporate tax rate they have reduced from 28% to 24%. Effective from 1st April 2020. But the problem was that enactment was not passed in the parliament, right? Before passing the enactment, the parliament got dissolved. Therefore, what will happen, all the companies, even though it was reduced to 28% to 24%, they will still provide at 28%, whether we don't know the new parliament will approve or not, right? Without taking the risk factor, all the companies, they have provided at 28%. Still, even though the tax rate, according to the government, they have reduced 28% to 24%, right? It needs to be enacted by the new parliament, which will be after this election. The new parliament will come into the parliament, and they will have to approve this new change, right? But make sure that in the currently up to now, if it is 24% or 28% doesn't matter. But if it is 28%, that company is more prudence company. Whereas if the company applies the tax rate of 24%, they took some risk, right? If the new government, we don't know, no? If the new government won't agree with the or approve the enactment, then you have to reverse back and have additional tax provisions on the same. Anyway, as a company, you have to pay tax, corporate tax. This is a simple format of an income statement, right? Uh, the heading is comprehensive income statement. I said comprehensive income statement have two parts: income statement and other comprehensive income statement, two separate statements. Now this comprehensive income statement have uh, the main income and the main expenses. The If you go to the other comprehensive income, now this is the other comprehensive income statement. This statement normally report, this is a separate statement starting from the net profit after tax. You can see the starting point of the other comprehensive income statement is the net profit after tax. From the start of the previous final outcome, that is net profit after tax, we only get counted in this statement are capital nature income and expenses. Capital nature income and expenses, right? If it is capital nature, it will not normally happen on a regular basis. After a considerable time, say 2 years, 5 years, 10 years, these income and expenses will happen, right? These income and expenses will happen. For example, the main the example you can understand is the revaluation gain or losses, right? I'll get an example for that revaluation gain and losses. Now I am sitting in a building IBSL 11. There are 11 stories and very big building. Normally at a cost of say 2 billion. They have invested 2 billion to construct this building. After say after 5 years time, valuer comes and estimate this building's value is 4 billion. 4 billion, even though the company invested only 2 billion in say 2015. Now they said the valuer, and the valuer says this building worth of 4 billion. A 2 billion increase. Invested 2 billion, now the value, current value is 4 billion. 2 billion increase. That is called a revaluation gain. That is called a revaluation gain, right? That income is a capital gain, won't happen in every month or every year. Those kind of gains and losses will be accounted in the other comprehensive income statement. Capital nature income and losses. Similarly, there can be losses also. If capital nature income and losses are there, it will be accounted in the other comprehensive income statement. The important point is when you put something in the other comprehensive income statement, it will have to be directly go to a reserve, right? When you credit here the other comprehensive income statement, it will have to go to the reserves. Now the example I took is the revaluation reserve. If there is a revaluation gain, you put a positive sign in the positive effect on the other comprehensive income statement, and a revaluation reserve will be credited and increase in the revaluation reserve, right? The important point is comprehensive income statement only carry income and losses of a normal nature. But other comprehensive income statement will carry the income and expenses of a capital nature, right? Which is do not normally trade as normal business profit. Capital nature. Now, if you take IBSL in a normal year, their profit might be say 100 million. their profit might be 100 million. Due to this revaluation gain of 2 billion, in the next year, they cannot say we have 2.1 billion profit, right? Therefore, that 2 billion won't be treated as a normal profit. That's why we treat that in the other comprehensive income statement, not in the main statement, profit and loss, right? Therefore, as a nutshell, if I summarize the income statement explanation, income statement has two parts: comprehensive income statement and the other comprehensive income statement. Comprehensive income statement will represent the normal income and expenses of a business. The last item or the final output of that comprehensive income statement will be the net profit after tax. Then the other comprehensive income statement, it will start from the net profit after tax, recognized in the comprehensive income statement, and add or deduct all the capital nature income and expenses. All the capital nature income and expenses will be added or deducted in the other comprehensive income statement, right? The other point is when you transact, when you record anything in the other comprehensive income statement, it has to be recognized as a reserve in the balance sheet. It has to be recognized as a reserve in the balance sheet, right? Right. Then the third statement under financial statement, that is statement of changes in equity. Statement of changes in equity. If you define the word equity, equity includes in a company stated capital plus reserves. Stated capital plus reserves, right? In this statement, the movement or the changes from the balance at the beginning of the year to the balance at the end of the year on equity items are shown. Basically, in this statement, how your equity and the reserves from the balance beginning of the year to the balance end of the year, what was the changes made, right? In order to show those changes, you prepare this statement, right? You prepare this statement. Equity items will include stated capital, capital reserves, revenue reserves, right? Every reserves are there. In revenue reserve columns, balances of the return earning brought forward from the previous year, current year comprehensive income, transfer to reserve, revaluation reserves, in dividend payments will be shown. Right. This is a format of a equity statement, changes in equity statement. You can see stated capital, capital reserves, retained earnings, revaluation reserve. There can be general reserves. Any number of reserves can be there. Now we'll start from the balance at the beginning. Then what are the comprehensive income for the period? Then transfers, any reductions, everything, dividend payments. Then as a result, what is the balance at the end of the period? Balance at the end of the period. Right. This is a format of a equity statement. Now I mentioned in the previous slide, any item in the other comprehensive income statement will have to come to as a reserves. If something recognized in the other comprehensive income statement, it should be recognized here as a reserve. Then fourth item is the statement of cash flow. Statement of cash flow. Even though most of the business organizations are reluctant to prepare cash flow statement, this is one of the most important statement you need to ask from your business clients, right? Without a cash flow statement, a business cannot survive. Now I explain cash and the profit is two different concepts. To take cash and the profit, those are two different concepts. Profit you normally derive from the basis of accrual concept, right? Now, profit after tax, profit for the year will be recognized based on the accrual concept. Based on the accrual concept. If you take the accrual concept, uh, whatever the income you recognize, whether it is received or not, if it is for a particular period, right? Whether income is received or not, not a fact that we take into account when we recognize an income based on the accrual concept. Whether it is received or not, that is not a fact. We basically think, right? We basically uses the concept whether that particular income belongs to the particular accounting period, right? For example, say uh, at the end of December 31st, even though some loans interest income not yet received, right? On cash basis, we recognize the interest income, right? Now, whatever the credit sales made in the month of December will be recognized as sales or income in the particular year, even though cash is not received. Cash will be received in the next year, but we recognize sales on credit basis for that particular period, even though cash is not received. Similarly, as far as expenses are concerned, even though the payment is not made, we recognize that payment in our income statement. The one of the good example is if your financial year ending 31st December, say 2019, normally 2019 December electricity bill, right? Now that electricity, 2019 electricity, December electricity will be was being used by the company to generate 2019 income, right? That electricity was used by the company to generate 2019 income, right? But the particular electricity bill, I mean the December month electricity bill will be received by the company in the month of January 2020. In the month of January 2020. And subsequently, you make the payment in the month of February 2020, right? Even though this 2019 in December month electricity was used to generate 2019 income, the bill will be received in 2020 January. Payment will be made in 2020 February, right? In that case, even though payment was not made, in 2019, based on the accrual concept, we take that electricity amount as an expense to 2019. That is called accrual concept. That is called accrual concept. Incomes and expenses will be recognized based on the year, not based on the payment or the actual receipt of income, right? But in cash concept, you take into account only the cash received and cash payment, not the accrual basis, right? In that case, in order to recognize whatever the cash income, cash inflows and cash outflows, we prepare a statement called cash flow statement. This cash flow statement, under cash flow statement, we categorize mainly three items: operating activities, investment activities, and finance activities. Under each item, we recognize what are the cash inflows and cash outflows for that business. right? In the cash flow statement and operating activities, we only take cash from cash sales and cash from debtors, not the sales, not the credit sales, not the cash sales. We only take under operating activities, as far as the sales is concerned, only the cash sales plus the cash received from debtors on credit sales. Similarly, for purchases, we only take cash purchases plus credit purchases, not the credit purchases, payment to creditors. Payments to creditors. Similarly, when we prepare the cash flow statement, we add back non-cash items. Like in the financial statement, we debit as an expense the depreciation, where depreciation will not be incurred as an normal cash payment, right? We have to add back that thing, right? Therefore, the cash flow statement will be prepared on a different basis, and it will show the activities and the cash flow amounts generated via these individual activities, mainly from investing, operation, and the financing. Now, if I take an example in the cash flow item in the investment activities, say you have you have sold the motor vehicle. Under cash flow, we only take the proceeds that we receive by selling of this motor vehicle. And but in the accounting, we prepare a disposal account of motor vehicle, and we take the cost, we take the accumulated depreciation, and we find out the written down value and compare the written down value with the sales proceeds, and compare, and we can conclude whether it is a profit or not, right? That amount will be reflected in the financial statement, the profit on disposal or loss on disposal of the motor vehicle. But in terms of cash flow statement, we only take the disposal proceeds. We are not worried about the profit. We are not worried about the cost, everything. We only take the disposal proceeds of the motor vehicle. It will be presented in the investment activities. Right. Only statement that collects and shows in one statement the causes of changes in cash during the financial statement period. At the end of the cash flow statement, you have to show the net cash inflows and outflows, and you have to add the cash and cash equivalent at the beginning, and finally it should be tally with the cash and equivalent at the end. Then I explained these two concepts previously also. Accounting policy, the accounting policies adopted by the entity should be clearly stated, describing the accounting methods and how matters are dealt in the presentation of financial statement, the assumptions, whatever the assumptions, whatever the concept, whatever the principles that you adopted in preparing the financial statement. For example, depreciation policy for motor vehicle, whether it is straight line or reducing balance, whether it is 20% or 50% or 10%, right? Then notes to the accounts. Notes indicate the breakdown and detailed analysis of items appearing in the income statement and balance sheet. Right? Detailed note should be presented if you want to describe further items in the face of the balance sheet. Very important here, as credit officers, if something is there in the face of the balance sheet or the income statement, you should have ask additional information from the accountant if there is a particular note is not given. Right. I'll go to the next tute as well. Since we have time, we'll break for 5 minutes and come back. I will start the next tute as well. Third session, since we have time, we will start this session also. This will be directly focusing on how you can analyze your financial statement presented by a particular credit client and the techniques that you can use in order to analyze the financial statement of a particular client. And not only analyzing and how to interpret the results of the analysis after you do a proper analysis. At the outset, we would like to say financial statement analysis is one source of information for assessing risk and return. Then the application of analytical tools and techniques to financial statement data, we can see there are different techniques and tools you can use, and allows users to focus on how numbers are related and how they have changed over the time to assess risk involved in lending. Basically, if you take the analytical techniques or the tool, there are three categories of analytical tools or techniques, namely horizontal analysis, vertical analysis, and the ratio analysis, right? Horizontal analysis, vertical analysis, and ratio analysis. Bulk of our time in this particular module will be consumed, will be given to the ratio analysis techniques rather than the horizontal and vertical analysis. But in day-to-day life, when I explain these first two techniques, you can see you are spending more than at least 40 to 60% of your time doing this horizontal and vertical analysis in your day-to-day works, right? We'll one by one explain what it is. If you take the first method, horizontal analysis, amounts and percentages of change, right? You take what is the amount and what is the percentage of change. Normally, the method is amount of change you can take later year amount, earlier year amount. Now, if it is difficult for you to understand that formula, we take 2019 and 2018. Later year mean 2019, earlier year mean 2018. If you take the difference of a particular item of these 2 years, that is called amount of change. Then you take the percentage of change also. You take the difference amount of change, divided it by earlier year change, that is from 2018. If I the example that I took, you take the difference between 2019 and 2018, divided it by 2018 amount into 100. That is called percentage of change. Right. We'll take some example and then you can get a better understanding of the concept, horizontal analysis. Now, this is a financial statement of a particular bank. Profit for the year ended 30th June 2017. Figures are mentioned in rupees million. If you take the interest income, current period, the main heading current period, actual is 3.6 billion, right? 3,600 million, 3.6 billion. Budget is 3,500 million. Then the variance against budget is 100. Variance against budget is 100. If you divide 100 by 3,500 into 100, that is variance against budget as a percentage, 2.86%. 2.86%. Similarly, previous year period, the interest income was 2.3 billion. That is 2,300 million. Then take the difference, that is 3,600 actual current year period, deduct 2,300 previous year. The difference is 1.3 billion, 1,300 million. To divide the 1,300 million or the 1.3 billion by 2.3 billion into 100, previous year figure, no? That is an increase of 56%. Increase of 56%. If you isolate the item interest income compared to budget, we have this particular bank interest income have increased 2.86% compared to the previous year interest income. They have increased 56%. Similarly, in interest expense, similar calculation can be done. I will only explain the increase part or the variance percentage part. Interest expense also compared to the budget, 1.77% increase. Compared to the previous year, 64% increase. 64% increase. Then the result of interest income and interest expense, the net interest income compared to the budget, 4.8% increase. 4.8% increase compared to the previous period, 44% increase. 44% increase. Last item, look at the last item, profit after tax. For the current period, 580 million. For the budgeted one, 520 million. Right? As a result, the variance is 60 million. To take against the budget, your profit is increased by 11%. Against the budget, profit has been increased 11%. Previous year, the profit after tax is only 420 million. Therefore, if you calculate the percentage increase compared to the previous year, it's 160. As a percentage, it is 38%. Right? The whatever the activities what we do under here is called horizontal analysis. Under horizontal analysis, we take the change of a particular year compared to the previous year, compared to the budget, even compared with the industry average. If you have the competitive figures, compared it with the competitive figures, we take the change, divided it by previous year amount or the comparative figure. If you compared it to budget, divided it by budget. If you compared with the industry figures, divided it by industry figures. If you compared with the previous period, compared it by divided it by previous period figure into 100, then you can have the percentage increase or percentage decrease. Right? This is called horizontal analysis. That's why I earlier at the beginning of the session I mentioned of this particular session, I mentioned even though you have not without knowing this is horizontal analysis, you do every day, you do these concepts, right? These analysis every day in your credit papers, right? Normally you do this, right? Very easy to understand, easy to compute, and easy to interpret also, right? I don't think further explanation needed as far as the horizontal analysis is concerned. You have to do this, right? Now, even though when I am explaining, the people know for sure that they know this concept and they will have a better understanding, but when it comes to exam, I am not a strictly marking lecturer. I am always try to pass most of the people when they sit for the exam. But unfortunately, more about 10 to 15% of the students, they are trying their level best to get fail in the exam, right? Even though I am trying my level best to pass them through, but they are trying their level best to get fail, right? Therefore, I will present some examples at the latter part of the lecture before concluding the lecture at the final stage with example, with live paper answer sheets, the fundamental mistakes. I don't think we should call them mistake. Those are negligence, right? uh, with those negligence, they are trying their level best to fail the exam. Even though I am trying to pass them, give some marks for them, they are trying their level best to fail the exam. Right. Okay. This is called horizontal analysis. Now we can go to the vertical analytical techniques. Vertical analysis techniques, which is not that straightforward, but which is also very simple to understand. After I describe those techniques, you can feel very easy to compute the vertical analysis results also. Right. Vertical analysis. It shows how each item in a financial statement compares to the total of that statement. Compared to the total of the statement. Normally, we do vertical analytical technique to the income statement and to the statement of financial position or the P&L or the balance sheet, right? Normally, we do not do this technique for the other statement, right? If you take the balance sheet, set both total assets and total liabilities as 100. In a balance sheet or the statement of financial position, one side you have total assets, other side you have total liabilities, which is comprised of equity plus liabilities. Now in vertical analysis, you set the total figure as 100. Total assets equal 100, total liability equals 100. Then compare individual, if the total assets is 100, what is the amount of percentage of the property, plant and equipment? What is the amount of percentage of stocks? What is the amount of percentage of cash, right? Similarly, if the total liabilities are 100, what is the percentage of equity? What is the percentage of stated capital? What is the percentage of reserves? What is the percentage of long-term liabilities? What is the percentage of bank loan? What is the percentage of trade creditors, right? Similarly, when it comes to income statement, the operating income, gross profit plus other income, not equal, right? Gross profit plus other income as 100 or turnover as 100. If the turnover is 100 or the operating profit is 100, what are the percentage of other items in the income statement? Say administrative expenses, say gross profit, say finance expenses, right? Net profit after tax. And identify the significant rupee and percentage changes, explain the change. Now, for better understanding and better explanation, we will take an example. Right. I have given the financial position of a company as at 31st December 2016. And compare the figures with 2015 and 2016. To take the figures at the very first, land 1000, in 15 750, motor vehicle 500, in 15 450, furniture in 216 100, to 15 150. Then stocks in 2016 250, debtors 350, cash 150, in 15 300, 250, 200. Total asset figure in 2016 2350, but in 2015 somewhat decrease 2100. Right. In every year, we set total asset figure as 100. Total asset figure as 100. If in 2016, 2350 total asset figure as 100, then what is the percentage of land? In order to calculate that percentage, you have to divide 1000 by 2350 into 100. 1000 divided by 2350 into 100. Then you can arrive at a figure called 43%. 43%. Similarly, if total asset figure is 100, 2350 is 100. What is the percentage of motor vehicle? 500, then it will be 21% of the total assets. 21% of the total assets. How do you calculate? 500 divided by 2350 into 100. Similarly, if you take 2016, individual item, you take individual item as a percentage of the total asset figure. Then land represent in 2016 43%, motor vehicle represent 21%, furniture represent 4%. Similarly, stocks 11%, 15% debtors, 6% cash respectively. Now, a similar way you can calculate for 2015 as well. 2015 as well. To calculate the figures for 2015, if the total asset 2100 in 2015 is 100, then motor vehicle is how much? Motor vehicle is 750. You have to calculate 750 divided by 2100 into 100. That is 36%. Meaning 36% of the total assets is land. 36% of the total asset is land. Similarly, 21% of the motor vehicle, out of the total asset, 21% of is motor vehicle. Out of the total assets, 7% is furniture in 2050. Stocks 14%, debtors 12%, cash 10% out of the total assets in 2050. Then once we do this, then we can do the analysis. How do you do the analysis? If you compare the land in 2016, it represented 43%, whereas in 15, 36%. That's how you compare. Compared to 2015, 2016, the imports, we have invested more in land. But in case of furniture, 15 it was 7%, representation of 7% of total asset, whereas in 16 it has come down to 4%. You can clearly see in figures as well, 150 to 100. Same way, imports of stocks in 16, 11%, 15, 14%. The imports have been reduced. Similarly, if you take the total of current assets, in 15, the total of current assets, if you add the total, 36%. But whereas in 2016, it is 32%. 36% against the 32% of the current assets. Right? Now, this vertical analytical techniques, the biggest benefit will be there when you compare different size companies. Different size companies. Say, if you compare one of the top banks, say government banks, right? One of the government banks, their asset size is more than 1 trillion. Compare it with a small size bank. Their asset size may be 250 billion. In that case, say the bigger bank, they have recorded 20 billion profit. 20 billion profit. Right? say their loan portfolio is out of the 1 trillion, their loan portfolio is 700 billion. 1 trillion total asset, 700 billion loan portfolio is there. But in case of a smaller bank, their total assets is 300, but their loan portfolio is 210 billion. 210 billion, right? I took, I will explain the example again. Two banks are there. One bank, their total assets figure is 1000 billion or 1 trillion. And their loan portfolio is 700 billion. Whereas you have a small size bank, their total asset figure is 300 billion, whereas their total loan portfolio is 210 billion. Now, whether you can compare 700 billion loan portfolio of a big bank with a 210 billion loan portfolio of a small bank, then straight away you can say the big bank loan portfolio is higher than the almost triple the loan portfolio of a small bank. That is not the case. But if you do a vertical analysis, the big bank, out of the total assets, the loan portfolio comprised of 70%. Out of 1000 billion, 700 billion means 70% of loan portfolio. Then in the small bank, out of 300 billion, 210 means again 70%. Therefore, when you are comparing different size of banks, right, the vertical analysis is the best analysis, right? Similarly, I can take another example for that also. Say profit figure, right? Out of the in the income statement, you can see a profit of in a big bank, say 20 billion. 20 billion profit is there. Their interest income is say their interest income is say 200 billion, right? Therefore, out of the total interest income, the percentage of profit is 10%. Similarly, a small size bank, their interest income might be 20 billion, but they have a profit figure of 1 billion. They have a profit figure of say 2 billion. Out of that, if you merely compare 20 billion profit with 2 billion profit, you cannot say the bigger bank has done well, right? To take the vertical analysis technique, out of the total interest income of 200 billion, 20 billion is 10%. Similarly, in the small bank, out of the 20 billion interest income, 2 billion is also 10%. Therefore, vertical analysis technique is the biggest advantage when you compare different size entities in a financial analysis. You can easily use the vertical analysis technique, right? You have to compare apples with apples, not apples with mangoes, right? Not you have to compare cows with cows, not cows with donkeys, right? Therefore, using the vertical analysis technique, easily you can compare different scales or different sizes companies using the vertical analysis technique. Right. I think now you have learned about horizontal analysis and the vertical analysis and a good understanding how to calculate or how to do a proper analysis under vertical and the horizontal analysis. Right. Then we'll come to our main topic, that is ratio analysis. Ratio analysis. We learn about the horizontal analysis. We learn about the vertical analysis, and our main topic is ratio analysis, right? Ratio analysis. Now, if you take the ratio as a concept, there is no accepted ratios in worldwide. But if you take the standards, if you take this accounting standard, those are legally accepted, and you have to uh, follow those accounting standards. But in case of ratios, the biggest disadvantage is there is no well defined, even though most of the people follow the ratio analysis techniques, uh, they have not like defined, and people can use different ratios to analyze in their own, right? uh, those are the disadvantages of having this ratio analysis. But for the time being, there is no well accepted the calculation methodologies for ratios, right? If you take a performance, it is a relative term. You can compare performance. Ratios are indicators of performance. What we do here under ratio analysis is we give some indications about the performance of a business entity, right? Using the ratio analysis technique. Uh, Shows the relative size of one financial statement component to another, right? Using the ratios, we can compare and contrast the financial statement of a business entity. And the last point is very important. Ratio analysis technique is not the only thing that you have to rely before making a decision, right? Whatever the output or whatever the outcomes, what we gain from doing ratio analysis technique should be used with other information, right? Then after using with the other information only, you can better be arrived at a better decision. Otherwise, uh, on an isolation basis, ratio analysis results cannot be used. Therefore, effective only when used in comparison with other ratios, analysis and information, not only the final results of the ratio analysis. Normally, ratio analysis, expression of units of ratios can be of various forms. Ratio is a measurement, and it is important to express a unit for the measurement. Some of the common units of expressing the ratios are as follows. Some ratios we express as percentages. Some ratios we express as a rupee term. Now, if you, I will call some examples also. If you take percentages, gross profit ratio is a percentage. Net profit ratio is a percentage. Then rupee terms, dividend per share is a rupee term ratio. Earning per share is a rupee term ratio. Then number of times, interest cover. Interest cover is a number of times. Then debtors turnover, number of times, right? Stock turnover, number of times. Sorry, that is for the fourth item. Then number, as a number, say 1, 2, or 3, right? As a number, not number of times, as a number, it can be given. For example, number of days, right? Number of days, the debtors collection period is 14 days. That is a number, right? Creditors payment period is 21 days. That is a number. Then as a fraction also you can give a ratio like 1/3 or 1/4, Like you can present a ratio also. Then as a proportionate, y is to z, say current ratio is 1 is to 2 of a particular company. Quick asset ratio 1 is to 2, right? Uh, those are the ways in which you can measure ratios or present the ratios after you calculate the ratios. I think this slide is the most important slide when you calculate ratios. This is a very important slide when you are calculating ratios, right? This gives a very good logic when you are calculating ratios. Make sure that you remember this slide when you are calculating ratios, right? Ratios are computed based on figures identified from the financial statement. You know the financial statement, mainly the income statement and the statement of financial position, P&L or balance sheet. Point A. Point A. Some ratios are computed from figures only from the income statement. There are some categories of ratios. In order to calculate that ratio category, we only take items from the income statement, not from any other statement. Items from the income statement. For example, say gross profit ratio. Normally, gross profit ratio calculate gross profit divided by sales. Both items, gross profit and the sales, are from the income statement. Point number B. Some ratios are computed from the figures only from the statement of financial position. That is balance sheet, right? In calculating those ratios, we only take the figures from the balance sheet. For example, say what kind of ratio? Mm, non-current assets to total equity. Non-current assets to total equity. There is a ratio, non-current assets to total equity. Both items are from the balance sheet. Both items are from the balance sheet. Right. So the point number A, we say some ratios are computed taking figures only from the income statement. Some ratios are computed taking figures only from the statement of financial position. Right. Part C, that is the most important part. Some ratios are computed from the figures from the income statement and statement of financial position. Right. Category C ratios, when we calculate those category type ratios, we take some figures from the income statement, some figures from the statement of financial positions. Say return on equity. Return on equity. We have to take the profit after tax from the income statement and equity from the balance sheet. Again, another ratio, debtors collection period. Debtors collection period, you have to take credit sales from the income statement, then debtors from the balance sheet, right? Now, under point C, first point, income statement is for a given period, usually for 1 year. Financial statement position is at a specific date, usually end of the year. Financial statement of financial position is for a given date. That is like a snapshot of a particular picture, right? After that point and before that point, the position will get changed, right? Therefore, make sure, right? Again, I am emphasizing the same point. Income statement figures are for a given year, for a period of 1 year. But for statement of financial position, it is for a particular date, right? It is for a particular date. Therefore, when computing the ratios under C above, that is 1 item from the income statement, one item from the statement of financial position. For the financial position data, the items from the financial position or the balance sheet, use average balances. You need to use average balances. How do you compute the average balances? Balance at the beginning, balance at the end into 0.5 or divided it by the total, you have to divide it by 2, right? Note, in the event of insufficient data for computation, year-end figure may be used instead. Now, if you are not given any information for you to calculate the average balances, in that case, you can use the year-end figures. But if you are provided with the figures to calculate average balances, in that case, you cannot use the year-end balances. In that case, you have to prepare the average balances. But where you can, where you need to take the average balance is under point C. That is, when you are computing a ratio, in that ratio, one item from the income statement and the second item from the statement of financial position. In that case, the second item, the item from the statement of financial position, need to be average balance, not a asset date balance, right? Right. At this point, I will like to conclude today's lecture. Next week also we'll meet at 7 a.m. I hope you will be all joining at the 7 a.m. Lecture. Next week, make sure that your present is there. We will calculate and using the ratio analysis, we will calculate and interpret and prepare report for a given example. And I will make sure that the beforehand I will upload the examples also next week. Right. Have a nice day. Thanks for listening. Okay.